Hello everyone, and welcome back to the channel where we demystify the world of hard-to-borrow stocks and potential short squeezes. Today, we're diving deep into a fascinating microcap name that's recently caught our attention, G Education Technology Group Company Limited, trading under the ticker GZ. This company is showing some very interesting metrics on our hard-to-borrow screener, and we're going to break down exactly why. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's start with a quick overview of G Education Technology Group Company Limited. This company operates in the technology sector, specifically information technology services, providing educational content products and IT services to higher education institutions in the People's Republic of China. It's a small player with a current market capitalization of just $8.06 million. Looking at recent price action, GZ has seen quite a ride. Today, shares are down 9.11%. Over the last 5 trading days, GZ is up 12.19%, but zoom out to the last 30 days, and the picture changes dramatically, with the stock down a staggering 96.14%. Volume today is extremely low at just 33,000 shares, significantly below its 30-day average volume of 323,234 shares, giving us a relative volume of only 0.1x the average. This low liquidity is an important factor to consider. What is cost to borrow and why it matters? Before we get into GZ specifics, let's quickly explain what cost to borrow or CTB is. When you short a stock, you're borrowing shares from a broker and selling them, hoping to buy them back later at a low price. Brokers charge a fee for lending you these shares. This fee is the cost to borrow, and it's usually expressed as an annualized percentage. Think of it like interest on a loan. Why does it matter? Because a high CTB means it's expensive to maintain a short position, and if the stock price moves against short sellers, these fees can quickly erode their profits or accelerate their losses, forcing them to cover their positions. Why this stock is hard to borrow right now. Now let's talk about G Education Technology Group Company Limited. GZ has appeared on our hard-to-borrow screener for some compelling reasons. The current cost to borrow fee for GZ is an astonishing 679.9% annualized. Highlight number that's not a typo. This number signifies extremely high demand to short G Education shares combined with very limited supply available to borrow. Furthermore, this CTB fee has shown incredible momentum, increasing by plus 567 percentage points over just the last 5 trading days. And how many shares are currently available to borrow? A minuscule 3,000 shares. While the estimated float for GZ is unknown, such a tiny number of available shares to short indicates a very tight supply-demand dynamic in the lending market. Our internal composite squeeze score for GZ, which combines these metrics with volume, price momentum, and technicals, currently stands at 43.6 out of 100, suggesting a moderate but notable potential for volatility. Squeeze mechanics explained. So, what does it mean when a stock like GZ is hard to borrow with such high fees? It means short sellers are paying a premium to bet against the company. If GZ price were to start rising, these short sellers would face increasing pressure. As the price goes up, their losses mount, and with an almost 680% annualized fee, the cost of simply holding their position becomes unsustainable. This can trigger a short squeeze, where short sellers are forced to buy back shares to close their positions. With only 3,000 shares available to borrow, if a significant number of shorts needed to cover, that limited supply could drive the price up very rapidly, creating a cascade effect. It's crucial to remember, though, that a high cost to borrow does not guarantee a squeeze. It can also indicate that short sellers have very strong conviction that the stock will decline, and they are willing to pay those high fees to stay short on G Education. Dilution risk check. A critical factor in any potential squeeze thesis is dilution. New share offerings can flood the market, negating any upward pressure from short covering. We've checked for recent dilutive SEC filings for G Education Technology Group Company Limited. We found no recent -1, -3, or 424B filings in the last 90 days, which is a positive sign. This means there's no immediate, overt risk of the company issuing a large number of new shares that could offset or negate a short squeeze thesis, even with such a high cost to borrow. Recent reverse split watch. Another important piece of the puzzle for GZ is its recent reverse stock split. G Education executed a 1-for-30 reverse stock split on July 6, 2024, which was just 8 days ago. A reverse split reduces the number of outstanding shares and, in theory, resets the share price higher. This is often done by microcap companies to meet exchange listing requirements or improve their stock's perceived value. Crucially, reverse splits also reduce the float, the number of shares available for public trading. Historically, many microcap stocks, particularly those with existing volatility, tend to see renewed volatility or even a price pop within about a month after a reverse split. This isn't a guarantee, of course, but it's a pattern we've observed in the market. For Giant Education, with a significantly reduced float post-split, any increased buying pressure could potentially have a more pronounced impact. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, what should you watch for with Giant Education Technology Group Company Limited (GZ)? Keep an eye on the cost to borrow fee as it continues to climb from its current 679.9%. What about the supply of borrowable shares? Will it shrink further from the current 3,000? Watch the daily volume. Any significant spikes above the 30-day average of 323,234 shares could indicate increasing interest. Also, monitor the price action for any sustained reversal from that steep 30-day decline of 96.14%. Finally, given the reverse split was just 8 days ago, the next few weeks could be a period of elevated volatility for GZ as the market adjusts to the new share structure. Giant Education Technology Group Company Limited (GZ) presents a unique situation with its extreme cost to borrow, dwindling share supply, recent reverse split, and a moderate squeeze score. While these factors highlight potential for volatility, it's essential to approach with caution and understand all the risks. Remember, a hard-to-borrow stock with a high CTB is not a guaranteed short squeeze, but it certainly puts it on the watch list for those interested in these unique market dynamics. If you found this breakdown of GZ valuable, please hit that like button, subscribe to the channel for more deep dives into hard-to-borrow stocks, and let us know in the comments what stocks you'd like us to analyze next. Thanks for watching, and we'll see you in the next video.